I can't prove it. I can't prove that I'll need care or you'll need care one way or the other. What I do know is if you need care, emotionally and physically, it's damaging to loved ones unless you have a way to pay for professional care.
All right, welcome to CVS Spotlight. If you are here by mistake, you are in the right place now. I am Michael Kohrmann.
I'm Eric Alvarado.
Awesome. And we are here today with the one and only Bill Comfort himself, owner of Comfort Long-Term Care and director of training for the CLTC designation. So just to let everyone know, this is a three-part series. Part one here, we're going to go over what is long-term care. Part two is going to be communication on how to have that conversation. And three is going to be our actual options. So now all the boring stuff's out of the way. Let's just hop right into it. Eric, what is our first question for Bill?
So, Bill, can you explain long-term care insurance for us and maybe start with the history of long-term care insurance?
Yeah, it's long-term care insurance really started out in the early 1970s as nursing home insurance. And of course, it was nursing home insurance in the 1970s because that was the only option. There wasn't private duty home care. There weren't assisted living facilities. So it started as kind of a fairly simple product in the 1970s. 1980s, we saw more and more companies get into it. We saw the introduction of group employee benefit policies, the addition of home care benefits into policies. And really, the early 1990s is kind of our bright line between policies back in the 70s and 80s that had no regulatory consistency, no benefit and contract design consistency. And we had both state regulations through the insurance commissioners starting in 1993, and then federal regulation of long-term care insurance through the HIPAA legislation in 1997. And HIPAA gives us all of these healthcare privacy rules. But the other thing that HIPAA did was HIPAA made very clear what role long-term care plays in our tax code. And effectively, long-term care insurance is now a form of health insurance in terms of tax-free benefits and the potential for tax deduction of at least some of the premiums in the federal tax code. The other thing that's important with this little bit of this history lesson is that some of the things that historically were always felt to be problematic with long-term care insurance. And we don't hear this as much anymore because policies that were issued back in the 1980s, there are fewer and fewer of those around. Sure. Back then, the average age was 65, 68 of people buying the insurance in the 80s. So we're kind of aging out of those old, what I'd call problematic policies being enforced. But I'll occasionally get a question today from somebody who says, well, what about some of these things that I've seen are problems, like, you don't want to buy a policy that has a prior hospitalization clause or, only provides skilled care at home. Well, the state regulators stopped that on all new policies, basically back to 1993.
Oh, wow.
So for over 30 years, we have not been able to issue any new contracts with things like step-down provisions and prior hospitalizations and problematic exclusions. And all of those state-level consumer protections are now part of our federal tax code, which has also given us a lot of uniformity among policies, particularly in the critical areas like access to benefits. How do you qualify to even start using the coverage? So that, the 1990s was really where we saw the start of what I'd call the modern era of long-term care insurance. We can talk about it separately, but obviously older policies before certainly 15 years ago, they weren't priced right. because we didn't know. We didn't have the
Right.
experience at which we now have to make corrections for. And I think sort of to pull this thread of history kind of all the way through, what we've seen in the last 15 years is a tremendous growth in the availability, not just in kind of the traditional type of long-term care insurance, but these newer hybrid or combo or linked benefit plans. Those terms all are kind of used interchangeably that combine life insurance or an annuity, perhaps, along with long-term care insurance. And it's actually a great time to be working in this field because there's so many options now for clients to have insurance to cover these costs.
That's awesome. So wait, when you say things were mispriced or we didn't know, can you dive into that? What exactly do you mean by that?
Yeah, the policies in the 1990s, which really were comprehensive in terms of what they covered, the way we expect it to be today.
Mm-hmm.
Of course, they covered nursing homes, but more importantly for most clients, covers home care, assisted living, dedicated memory care. And really for most people buying long-term care insurance, nursing homes are the last resort. This isn't nursing home insurance
Right.
anymore. If you like, it's really stay out of the nursing home insurance for people who own it. So in the 1990s and even a bit into the early 2000s, we didn't have claims experience because it takes about 20 years for policies. The expectation is that claims won't start for at least 15, if not 20 years or more. It's a very long lead kind of a policy.
Sure.
Clients need to buy it way ahead of the need for care, and insurance companies have to price it way ahead of when the claims will actually come in. So, particularly in the 1990s, as home care was really, and assisted living was being added to policies, and we were getting consistency around when benefits could begin, the benefit eligibility criteria.
Sure.
We had a lot of consistency for that. The carriers looked at other similar products.
Mm-hmm.
It's not quite disability insurance. It's not quite individual health insurance. But they borrowed some of their assumptions from those other products. And we missed them, both what's called the lapse ratio, the number of people who voluntarily give up their coverage over time,
Sure.
interest rate assumptions on the earnings. We all know what happened in 2008, 2009 to interest rates. They not only went historically low, they stayed historically low for historically long. And the third piece, which could only have been learned through experience, was the duration of claims. Once people start care, it's interesting all the way back to the early 1990s. And we have incredible claims data now compared to even 10 and 15 years ago, because all of that business is, coming to maturity. It's credible data, not just actuarial guesstimates anymore, but actual actuarial data to inform us. We hit the claims rate pretty much on the nose. Somewhere around 30 to 40% of policyholders will go on claim long enough to get at least $1 of benefits.
Okay.
Wow.
The problem is nobody lapsed the coverage. So there's something like 3 times the number of people with policies still in force.
No one was letting
And
go of any
interest. Right. So it was kind of a perfect storm of mistakes, and it wasn't because they were trying to mislead the consumers. There was no data because nobody designed a product like this before.
of it. Okay.
Makes sense.
Wow. Thank you
I
very
remember
much,
too
Bill.
that a lot of those benefits, I remember seeing a lot of benefits and policies that were like lifetime benefits as well, right? So not only was the duration or the pricing off, but it seemed like they were giving away lifetime benefits for a super low cost, which was great for the clients, but the insurance carriers paid for it, right? So.
And of course, if anybody knows a little bit, has done any kind of reading or exploration of the subject, either clients or their advisors, we know that traditional type of long-term care policies, which is really where most of the history is, have had significant in-force rate increases that have been approved and granted by the insurance commissioners because the carriers need those increases to keep up with the claims, to fix the mispricing. But the connection that's missed is the new policies being written and issued today already have all those past mistakes corrected for in today's rates.
Oh.
So if you're buying today, you're already buying at the higher, more experience-based, more conservative assumption levels already today. Some policies still are not guaranteed, but we are not going to see 100, 200, 300% rate increases going forward because those increases that happened in the past, the factors have already been baked into the new rates for all the coverage.
Awesome. That is really powerful to know. Well, thank you for that history lesson with the long-term care. That segues us perfectly into the next question is, what exactly is long-term care? What does that mean? How do we define that?
Yeah, it's a good question. And I think it's important to recognize there's two aspects. And as we get into the later segments of this conversation, when we talk about planning for care, what is care? What does that mean? And that's just the need for help, impairments or limitations, that could visit us as we age,
Sure.
accident, illness, or frailty. The need for help is care, very broadly. But since we're kind of focusing on long-term care insurance, let's define or talk about how does long-term care insurance define care at the level that you could begin using the insurance, right? And as I mentioned just a moment ago, that standard is pretty much now universal again across all the long-term care insurance companies and products, because it's coming from the federal tax code that sets some of this. So, if somebody needs help paying their bills, if somebody needs help with transportation or keeping their house clean because they just can't do it anymore as they age, that's not long-term care in this context.
Okay.
It's probably important help.
Sure.
You might need to plan for it, but if that's all you need, that's on you. So long-term care insurance eligibility for benefits is defined one of two ways. And it's really important to keep these separate because they're two different tracks, if you like. Okay. One way is needing supervision, needing someone around because of a cognitive impairment, a mental limitation. And we think of things like Alzheimer's and dementia as we age, but it could be a head injury.
Sure.
Right? A bike accident or a car accident, or a stroke that affects the computer, not the machine. So supervision because of a cognitive impairment where you're not safe getting through the day on your own. So that's one measure. The other measure, which again is looked at separately, it can be either or, is physical assistance. And the term that's used is activities of daily living, or ADLs. And long-term care insurance, in fact, the tax code uses a list of 6 physical activities. And if you need help with any 2, you're eligible for benefits. And the activities are bathing, dressing, transferring, which is getting in and out of bed or a chair, using the toilet, eating, and continence, maintaining and managing your continence. So if you need help with any 2, now this is so important to understand on a couple levels. What kind of help? Obviously, if somebody has to physically pick you up out of a chair, that's what's called hands-on help. That's pretty obvious. Physically has to hold you as you step in and out of the shower. That would qualify, certainly.
Mm-hmm.
All long-term care insurance that is sold today, and this is allowed for, even somewhat prescribed in the tax code, help can be measured by simply standby help. So if you simply need somebody close by just in case, balance issues, fall risk, frailties, when you're, showering and dressing, for example, you can do it, but somebody needs to be there. That's when the worries start. That's when the safety's an issue. And that's when long-term care insurance can also begin providing benefits. So at least standby assistance physically or supervision for your safety because of cognitive limitations. I like to say long-term care and even long-term care insurance benefits start way before you're flat on your back and able to do anything.
No, I mean, so if I can collectively, I get that, then there's two levers that turn on LTC. One of them is pure cognitive, which that can turn everything on, and the other ones are the activities of daily living, but they're measured separately. And
Correct.
And not everything is nursing home. It's home health care, supervision, hands-on, hands-off supervision.
Right.
And so all of that counts as long-term care.
Yeah, absolutely. And let me give you a story to kind of illustrate that. I had clients, husband and wife, who had purchased long-term care insurance from me. So this was not a getting them to recognize the need for it. They'd already bought it. And I got a call from the wife who said, hey, we'd like you to come over to the house and talk to us about our long-term care insurance, help us understand it. I think it's time we start benefits for Richard. And I said, okay, what's going on? And she explained he had balance issues. He was fainting. He'd had 3 falls, broken ribs, head lacerations.
Ow.
And I'm like, gosh, it sounds like, this is probably an ADL claim. And as we talked, it was clear that the falls had all occurred when his wife was away from home. So he wasn't managing his physical movements as well if she wasn't there. He'd forget to grab his cane or forget to use his walker and was having these falls. So that's it. And we sat down and we talked through all of this, and he agreed, it's probably time to start a claim on at least a standby basis, which is what it was. And just to kind of play this out, the husband said, I understand we could use the policy, but I'm not sure I'm ready for a stranger to be in the house. And that's a very common feeling. I even get it, right? And I said to him, Rich, in some ways at this point, the caregiver who is here with you is not so much for you. It's for Barb. So she can go to the grocery store without being terrified. She's going to come back and find you on the floor. There's some kind of harsh realities about care that we've got to confront. It's not an easy subject.
Right.
But it was, and of course, his life and lifestyle improved with that caregiver helping him as well. So
good.
I hope that helps illustrate Michael, the idea.
No, it's not just this. I've heard the term "use it or lose it." They're like, "Oh, well, my grandparents bought it and they tried to use it and they could never get anything out of it, so they just wasted their money." And that's just, it's not the reality of long-term care anymore.
Right.
And I when I hear stories like that, particularly folks who are now maybe in their late 50s, early 60s, which is really the sweet spot for buying this insurance.
Sure.
Because it's the right life stage and there's still a lot of health and independence. when did their grandparents buy the policy? If they bought it in the late 80s, maybe the very early 1990s, the definitions were not as good as they are today. So one of the reasons it might not have ever worked is maybe they wanted home care, but the policy didn't cover it back then. So
Excellent point.
sometimes, we have to smoke out what's the reason for the negative experiences. And the idea of use it or lose it, I hear it. Listen, the traditional type of policy where you pay a premium along the way for care, it is, I suppose, use it or lose it, but it's also the lowest possible premium for the maximum amount of coverage, which is how insurance is kind of supposed to work. Right. And we have to be really careful when we're beginning to compare sort of policies that have no death benefit, have no cash value, with maybe a policy that has a death benefit that would return the premium in a way to your estate if you never need care. But how much more premium did you pay for the privilege? Right? Because there's an opportunity cost that has to be taken into account. Either way, I should say, and I know this is the way that you all do business as well, the whole discussion around different types of policies, how they're designed, the hybrids or the traditionals or whatever.
Sure.
One is not inherently better than the other. They're different ways to fund this risk. And the right option is what's right for any particular individual client.
Absolutely. Bill, that was great. Can you dispel any rumors or myths about LTC? Maybe like the whole 7 out of 10 or the 2 out of 3 over the age of 65 will need care conversation?
Yeah, that's really interesting that you bring up those statistics. And we see it everywhere. It's become kind of conventional wisdom. 7 out of 10 people will need care. Look, why are more people not taking action? They obviously don't believe those numbers. Now, it almost doesn't matter if it's true or not. What is it that will cause an individual to take action first just to meet with an advisor to talk about what is a plan for care? How might I pay for professional care? So it's interesting, the 7 out of 10 statistic, the 70%, includes people who will only need help with those instrumental activities we mentioned: cooking, cleaning, laundry, bill paying, transportation. There's a more recent study, actually by the same research group, the Urban Institute, and funded by the Department of Health and Human Services. So this is government data again. And what they looked at was, what are the odds of needing care at the level that would qualify you for benefits from long-term care insurance? That's those 2 out of 6 ADLs or supervision for cognitive. And the most recent study they did on this with more up-to-date data said it's about 56%. Now, that's more than 1 out of 2.
That's pretty high.
And I want to share a statistic with you that will sound a little flip, but it's really what we have to think about as we personalize it. So, for any of us, Eric, for you, for me, the risk is not 56% that I'm going to need care. For me, it's either 0 or 100. 56% is the population broadly.
Yeah, you're either going to not get sick and just die, or actually need help at some point along the line.
And from a planning perspective, 0's easy, right? But what if it's 100?
Very easy.
If it's 100, if you're the one that it happens to, or if it's your spouse that it happens to, or your parent that it happens to, now we have a whole new set of issues and problems that are there. So, even 56% is a huge risk, and has to be considered. And really the question is this, and this ties properly long-term care planning to good retirement and investment planning. People planning for retirement, starting retirement, in retirement, or still in those pre-retirement years, 50s, early 60s. Their retirement planning, the numbers, the data, the analysis, all includes projections that say this money has to last to age 90, if not longer. Clients already believe this, that it's possible, it's even reasonable, and has to be planned for. So the long-term care pivot is, if it's reasonable to expect to live to 90, if not longer, isn't it reasonable that you could need care for a few years along the way?
Yeah,
Absolutely.
exceedingly.
Yeah.
I can't prove it. I can't prove that I'll need care or you'll need care one way or the other. What I do know is if you need care, emotionally and physically, it's damaging to loved ones unless you have a way to pay for professional care. And that's the financial consequence that comes.
Okay. That actually segues us into this next question, though, that I have for you is, from a profile perspective, what should advisors be looking for a long-term care client? What should they, when they're looking at their book of business, how do they identify who that person is that needs to have that conversation?
I'll make it really easy. Every single client. Now, let me,
All right.
let me, and I say that in total seriousness and without meaning for it to be flip. And I realize it can kind of maybe sound that way. Every client deserves a personalized, detailed, individualized conversation about planning for care. And here's a way to kind of separate a couple of issues. Everyone needs a plan for care. Everyone needs to understand what their plan is or could be, how it will work, and are they willing to live with that? But not everyone needs long-term care insurance, right?
Fair.
Long-term care insurance is just a way to help fund, to pay for the professional care. But everyone needs a plan. And I got to tell you, I hear so many advisors say, and they may be generally right. You know, their book of business, the size of assets under management that they work with. But I hear advice. Here's the exact words I hear all the time. Well, Bill, most of my clients can probably self-fund, self-insure. Probably.
Yeah.
Probably is your planning position. And I realize I'm being a little strident with this.
Sure.
But so he says, well, yeah, you know, they have X amount in assets. Okay. Is that your decision or is it their plan? And again, I don't mean for this to be critical as much as challenging. No. Every client needs an in-depth, serious discussion. By the way, self-funding is not an option you choose in the future. Self-funding is the in-force plan that exists today. And you got to game it out. You got to see how it's going to work. You got to look at the impact on the portfolio and the lifestyle and the financial security issues for the family. So, you know, now, ideally for buying the insurance, which I think maybe was a little bit more of your question, 50 to 70, 45 to 70 is kind of the broad range. 50 to 65, if not 55 to 65 is kind of the sweet spot for health, affordability, and life stage readiness. Earlier is better, if possible, but for sure by late 50s, you got to be getting into this. And yeah, I mean, but every client deserves a significant detailed discussion.
I like that. I very like the way every client deserves the conversation. Not every client necessarily needs the actual insurance itself.
That's correct. And yeah,
Very
that's
well
the best way to put it. So it's not saying everyone has to buy this insurance. Not everybody can. Might not be able to afford
Sure.
it. They might not qualify medically. But if either of those two things happen, so how else are you going to pay for care? What else might have to be looked at in the overall, investment and financial planning scope of the advisory and client relationship?
Awesome. Well, thank you very much for taking the time to speak with us today, Bill. I really, really appreciate it. Do you have any closing comments for the audience?
Really just to understand that long-term care starts well before most people imagine, and everyone needs a plan for care. So if you're the client, bring it up with your advisor. If you're the advisor, bring it up with every client.
Very, very well said.
Well said. Yep.
Well, I am Michael Kohrmann,
And I'm Eric Alvarado.
and this has been CBS Spotlight, your friendly conversation about insurance and wealth advising come together. This has been part 1 of 3 of an LTC series with Bill. So stay tuned for part 2, and don't forget to like and subscribe if you find this to be valuable. But part 2 will be the conversation on how to have this conversation with your aging parents, and then how to have this conversation with your clients. Thanks.